Well, greetings and salutations, FINRA and NASA test takers. We do evening classes every now and again. This is a Friday. Yes, Friday night, and here we are talking about mutual funds. Woohoo. So someday you'll have your Friday nights back to yourself. I put up these classes. You can find these classes at dean10tutoring.setmore.com. And you get with the class a access to the free office hour as well. So if, by the way, this isn't if you're watching this on a video replay. For people who have paid money for the class who are joining us this evening, they have access to that free office hour. Sometimes I know Micheline and I was two of us, and I think Christina, and sometimes that can end up being just you. It just depends. And if so, it's a $225 value because that's what we charge for tutoring. So feel free to take advantage of that on the schedule as well. Tonight, we're talking about a topic that's on all the exams. It's on the SIE, it's on the Series 6, the 7, the 65, the 66. You know, mutual funds are the investment vehicle that most people get where they're going without crashing and burning. You know, if I, joke, but if you're a Series 7 and you go to your manager and say, hey, I know I have a Series 7, but it is okay if I just sell mutual funds. Your manager would say, that would be wonderful. You know, if you come back and you have a Series 7, you go, man, I just love this margin stuff and options and, wildcat oil and gas programs. The number one reason to buy a mutual fund is for professional management. Clarice is a good friend of mine. She's worked very hard to accumulate for which her is a lot of money, $4,000. And I say, Clarice, do you have the time, temperament, and expertise to be managing money? For most people, that answer is going to be no. And I said, well, then you ought to consider hiring a professional money manager. And she, man, I can hire a professional money manager with as little as $4,000. I mean, I see those people on TV saying their minimum relationship is like $500,000. I said, Clarice, there are men and women who've sold their soul to manage that money for you. You can invest as little as $500. Now, the professional management is provided by a registered investment advisor. So, for example, the Fidelity funds, the registered investment advisor is Fidelity Management and Research. They only have one client, the Fidelity funds, and they're federally covered, right? They're meet the ABC definition. They're giving investment advice. They're in the business of giving investment advice, and they want compensation. Now, the manager test question is typically the largest single expense to the fund. The largest single expense. I say there is a problem with having monkeys harvest bananas. And the problem is the monkeys eat the bananas. Now, be careful what you're being asked. We always say RTFQ, read the full question. If I ask what's the largest single expense to your customer, different question. That's the load. The load isn't paid by the fund. The load is paid by the customer. If I ask the single largest expense to the fund, that's the management fee. Now, that's low cost as compared to other things. Oh, for example, a hedge fund. A hedge fund's cost structure is way higher than this. Typically a hedge fund is going to charge you 2% of the assets under management and 20% of the profits. So again, this is a low-cost way to access professional money management. You get diversification. 10 equally suitable ideas. I pick one of them, 10. The other 9 do fine. The one I picked goes bankrupt. Very testable. That's called selection risk or non-systematic risk. And the easiest way to avoid selection risk or non-systematic risk, looks like I had a typo on my slide there, I should say non-systematic risk, is through diversification. Bernard Baruch said money is like manure and you ought to spread it around. You just pile it up in one place, it just stinks. Now, one of the test questions is you can mitigate non-systematic risk or selection risk through diversification. But one risk you still have in a mutual fund is systematic risk. I don't care what mutual fund you have. If the market goes down 30% today, the NAV of your fund probably went down as well. right? So risk prevails despite your diversification. We said mutual funds have a low minimum investment. You know, I haven't been in the business. I started as a retail broker and ended up as an institutional broker. But when I was a retail broker, there were funds that you could get involved with for as little as $500. I wouldn't be surprised if somebody who's a practitioner said, Dean, I got a fund that with a letter of intent will let you in at 50. I go, woo, you know. And it's just easier owning mutual funds than it is owning other things. You know, if you have a portfolio of, 50 stocks, I might intend to read all the quarterly reports and all the annual reports and do all my homework. Well, it's just easier owning mutual funds than it is owning individual securities. All right, so let's dig in with this evening's discussion. As I said, the three major reasons we would buy a mutual fund is professional management. The management is provided by a registered investment advisor. Diversification, testable. If I want to hold myself out as a diversified mutual fund, I have to have my invested monies invested in such a fashion that 75% of my portfolio, let's put some numbers to it to make it a little easier. I'm managing a $100 million portfolio. I have to have 75 million invested in such a fashion that no more than 5 million is in any one position, and I'm not allowed to be a principal stockholder. I can't own 10%, more than 10% of the target company stock. Makes sense, by the way, because remember a separate test issue. If you're a principal stockholder, you're subject to volume restrictions. And we can't be that as a mutual fund because mutual funds have to be willing to meet redemption requests. Now, we're not trying to guarantee mediocrity here or diversification. So please note, I have 25 million in my hypothetical that I can load up. And I said ease of ownership. This is one of the most testable slides that I have. This slide is so target rich. There's easily 5, 10 points on this slide. One of the things you have to be able to do is contrast an open-end mutual fund with a closed-end mutual fund. You know, in an open-end mutual fund, we're continually offering shares to the public. And remember, whenever the issuer is receiving the proceeds, and here the issuer is the mutual fund, that is a primary transaction. All of those transactions together are called the primary market. So open-end funds trade in the primary market. The primary market. That means not only do we have to comply when selling open-end mutual funds with the Investment Company Act of 1940, we're also going to have to comply with what is the act that governs selling brand new securities to the public.
33.
Right on, right? 33. You got to get people a prospectus.
Paper Act.
Make an informed decision. They must redeem shares at the next computation of the NAV. Test question. They have to do that at least once per business day. So once per business day, typically after the market closes, the fund is going to take its assets minus its liabilities, divide by the number of shares outstanding, and come up with the NAV per share. They're doing that once per business day. You say, Dean, I would like to redeem. I said, well, I'll send your redemption request in, and we'll get a redemption honored within 7 calendar days. And you say, Dean, how much money am I going to get? I say, I do not know. I don't know until we do the next computation of the NAV. This idea that we're always doing business, either coming into the fund or coming out of the fund based on the next calculation of NAV is testable. Do you know what that's called? This idea that we're always doing business?
Forward pricing.
Yeah, that's right. And some people don't like this idea, you know. So when we talk about other products, we'll talk about, you know, how you can avoid that. Be careful on this next one. RTFQ, as we always say, read the full question, read the full answer set. I'm not about to tell you that open-end funds can't own preferred stock. I'm not saying they can't own preferred stock. Many mutual funds do. I'm not saying open-end funds can't own bonds. Open-end funds own bonds. We have entire mutual funds that are bond funds. What I'm saying is that an open-end fund cannot issue preferred stock, cannot issue bonds. Boy, right? So all the money they have that comes from selling common shares, common stock, A shares, B shares, C shares, whatever the case may be. I'm not a good prospect for a domestic mutual fund. Call it hubris on my part. But if you say, hey, Dean, do you have the time, temperament, expertise to be managing money? I'm going to say, yeah. Did it professionally for 30 years. So I'm not a good prospect. But I'd be the first to admit that perhaps there are areas where I should make an asset allocation where perhaps I don't have the time, the temperament, or the expertise. For example, maybe Mexico. And maybe I decide I want to access professional management. I could do that through a closed-end fund called the Mexico Fund. The Mexico Fund trades MXF on the New York Stock Exchange. So they did a one-time initial public offering, and then now it trades in the secondary market. The shares are not redeemable. I would want them to be redeemable. I'm going to say, listen, Michael, if you can't handle the volatility of the Mexican market, we'll be damned if we're liquidating securities to cash you out. No, you simply sell your shares to someone else for more than or less than you originally paid. The manager is never going to have to meet a redemption request. Now, the Mexico Fund wanted to. The Mexico Fund could issue preferred stock in the Mexico Fund and make additional investments within Mexico. Promise the Mexico Fund preferred shareholders 4%, make additional investments. If the Mexico Fund chose to, they could issue debentures, promise them 5%, and to make additional investments within Mexico. Not true of an open-end fund. So main point, closed-end funds have more flexibility. And with more flexibility, comes more risk to me as a client, because the manager can do things that, open-end fund managers cannot. Biggest testable distinction. Open-end funds do not trade in the secondary market, whereas closed-end funds do. Closed-end funds trade like a stock, MXF on the New York. And what makes the stock go up or down isn't the NAV. It's more supply of Mexico Fund shares than demand. The Mexico Fund shares go down. More demand for Mexico Fund shares than supply of Mexico Fund shares. The shares go up. They can either be trading at a premium to the NAV or at NAV or a discount to NAV. Not true of an open-end fund. An open-end fund is priced by a formula, and that formula, let me get myself some space here. Is the NAV plus the sales charge equals the public offering price. The NAV plus the sales charge equals the public offering price. Now, for example, let me just make up one. I'm making this up. When we took the assets, we minus the liabilities, we divided by the number of shares outstanding, we came up with $9.15. And let's say the sales charge is 85 cents. I just made that up. And that means the public offering price is 10. Very testable. The maximum sales charge for a mutual fund is 8.5%. And as you can see here in this example, I'm at the legal limit. 85 cents divided by 10, 8.5%. I love this. It's just for your own edification. It's not testable, but if you charge somebody 8.5%, that's called a full service fund. If you're going to charge somebody 8.5%, you got to show them a lot of love. Most of the stuff varies from fund to fund as stipulated in the prospectus, but not if you're charging somebody 8.5%. You got to give them a breakpoint. Question. So if mutual funds are open-end funds, what are examples of closed-end funds? I don't know when you put that in the chat, McLean, but I just spent, I think, 10 minutes talking about the Mexico. Did I not? And told you the Mexico fund is a closed-end fund. I think I just did that.
So, but yeah, but like you have the MXF and it just has its own like ticker or whatnot.
Yeah,
I
it
guess.
trades just like a stock. Just
Okay.
like a stock. All right, X date. X is Latin for without. Right. So I say, do you have an ex spouse? That means you're no longer trading with your spouse attached. And the X date for a security is the first date on which the stock no longer trades with the dividend attached. Now, remember, when there's no secondary trading, then it's not a function of the Uniform Practice Code. There is no secondary trading. The mutual fund knows who is on their shareholder list at any given time. Unlike a closed-end fund where there are people buying and selling the Mexico fund. You know, when you're buying and selling in the secondary market, remember, ownership doesn't change hands until T+1. Trade date is when we agree to terms. The settlement date is when ownership changes. That's not true in an open-end mutual fund. So all of the dates, the declared date, the X date, the record date, payable date are all set by the fund. Whereas in a closed-end fund like a stock, it's a function of the Uniform Practice Code, which standardizes trading within the securities industry. And so in the Mexico fund, the X date is the same as the record date, right? Because if I buy it on the record date, I'm not there on the record date. I won't be there until tomorrow. And then that means I'm not going to get the dividend because I have to be on the shareholder list. When we get to ETFs, I got a whole slide to compare ETFs with open-end mutual funds because it's very testable. You've been steering people away from mutual funds to ETFs? Yeah, we'll be talking about ETFs. As I said, I'm setting up that discussion, Ethan, by saying there are some things that people don't like about mutual funds. And so when we get to ETFs, we'll say, okay, well, how come people like these ETFs as compared to mutual funds? Right. So that's what we talk about. I got a slide here. This is another good slide. I love, of course, obviously I love my slides. Open end versus closed end. Open end versus closed end. Is it RTFQ? Is it DREP, declared record X payable, or is it DERP? Now, the reason I still have DERP here is because the X date emanates from the record. The X is from the record, not record X. And here we're talking about, again, an open end versus a closed end fund. The board of directors of an open end fund declares a dividend. They say, we're going to look at our shareholder list on this date. And if you're a shareholder in our open end mutual fund on this date, you get the dividend. If you're not a shareholder on this date, the record date, shareholder as a record, you do not get the dividend. And then we said in an open end mutual fund, the X date is going to be 1 business day after the record and the payable date. And we said all of these dates are set by the board of directors. In a closed-end fund, if the Mexico fund declares a dividend, the X date is the same day as the record date. X meaning if you buy it on the record date, you don't get the dividend. And the declared date, record date, and payable date are all set by the board. The X date is not a function of the board. The X date is a function of secondary trading. Very testable. In the securities industry, we have a code of conduct. And outside of the securities industry, I should stay still within the securities industry, state administrators have a template of what they call unethical business practices. And so, I call you the day before the dividend. I say, hey, if you buy it today, you get the dividend, but if you wait till tomorrow, no dividend. You've heard of dividend capture programs, haven't you? And you say, well, Dean, isn't it going down by the dividend? Isn't that just creating for me an unnecessary tax situation? I said, well, gee, you're no fun. You say, Dean, can I talk to your supervisor? Using the X date as an artifice, an artificial sense of urgency to get somebody to buy the mutual fund is a big, big no-no. Is there any tricky multiple ways that test makers may refer to either open-end or closed-end funds? I don't think so. We're referring to mutual fund usually mean open-end. So I wouldn't be looking for closed unless we specifically say closed. Now, the most common share class that people have, in fact, most mutual fund companies have gone back to the A shares because people get so confused about the other share classes. We will be talking about A shares, B shares, and C shares. And so the A share is the most testable type of share class, and it has a front end load. So here, you decide to invest in this mutual fund, and it has an 8.5% maximum sales charge. Wow. I don't have any mutual funds anymore that charge 8.5%. Crazy. So I say make the check payable to the mutual fund sponsor, underwriter, distributor. That is a FINRA member firm, like Franklin Templeton Fund Distributors. The mutual fund distributor is going to cash that check, and they're going to deduct the load, which in this case is $850. Now, I would typically get, as a broker, a percentage of that. Right. So my payout when I was a baby broker, retail broker, was 50%. So I would have made $425 on that transaction. The $9,150 goes into the fund at the next calculation of the NAV. And we said that that's levied at the time there. And here's an example again of that formula. The NAV plus the sales charge equals the public offering price. Very testable. It's always quoted as a percentage of the public offering price. There are two scenarios that show up on the test. One scenario that shows up on the test is when given the NAV and the percentage are in the sales charge, NAV and sales charge, calculate the percentage sales charge. And the way you do that is you take POP, public offering price, minus NAV, 85 cents, and you divide by that and you get 8.5%. Now, if we do that math and we come up with something more than 8.5%, your point, Micheline, if we come up with 10% or 11% or 12%, it can't be an open-end fund, because open-end funds can only charge a max of 8.5. So if we do that math and we come up with 10 or 11, it must be what kind of a fund?
Closed-end.
Closed-end fund, indeed.
So you wouldn't know that unless you did some of that math just to find out.
You might have to do that math on these exams. Indeed, I got a little slide here in just a moment. And I just told you there's two scenarios, and I'm going to show you both. Here are the two scenarios that show up on the test. When given the NAV and the public offering price, calculate the percentage sales charge. The other scenario that shows up on the test is when given the NAV and the percentage sales charge, calculate the POP. I'm going to show you both in just a minute. But before I do, A shares, which we're discussing now, have a lower operating expense. They typically have breakpoint. Breakpoints are good. That's a quantity discount. I think of Breakpoints. I always think of Costco. I say, man, I don't need 2 tons of salsa, but it's so cheap. And the reason I get it cheaper at Costco is because I'm buying in what?
Bulk.
Right. So I go, oh man, what was I thinking? Right. We're going to be talking about letters of intent. And then very testable, the A share is going to be suitable for somebody who has a large amount to invest because they might qualify for a breakpoint and a long time horizon. Mutual funds are for the long term. Mutual funds are for the long term.
Is there like an unwritten rule of how much people generally go into A shares, B or C?
Nope. No, I don't. I've never heard of an unwritten rule. I think those are applied to baseball, not investments, right? All right. So in my example, we said the way we're going to figure out the percentage sales charge, and if you follow me, that Dean says if you can't remember what math to do, what math should you always do if you can't remember what math? Always. I'd be doing a service to you to tell you to mask your calculator and, every key except divide. So in our example, let's do our example. We had a POP of $10 and we had an NAV of $9.15. And so we established a sales load. We established a sales load of 85 cents. And we divide that by the public offering price. And we find out that's 8.5%. So that's one scenario that shows up on the exam. I might say, hey, you qualify for a reduced sales charge. You're not paying 8.5, Philip, because you've qualified for a 7% sales charge. And paying 7% is certainly better than paying 8.5. And Philip says, well, Dean, what is my public offering price based on paying 7? Because the 10 is based on people paying 8.5. I go, indeed it is. And he says, okay, well, let's figure out what that would be. And the way we do that is we take the NAV, the net asset value, and again, we're going to divide. And this is kind of cool, Philip. What's kind of cool is you have 93 cents going into the fund now instead of, 91.5 cents going into the fund. You got more money going into the fund, which is a wonderful thing. So of your dollar, 100 cents or a dollar, whatever you want to think about, I like to think of it as, money. And now you've got 7%. That ain't going into the fund. Now, boom. And that's the sales load. That's why we're going to do this. We're going to take, and this will give us the new public offering price based on somebody who's paying 7 instead of 8.5. I just made up the 7 to illustrate this. So that's, given information. And so this is our second scenario on the test. The second scenario is when given the NAV and the percentage sales charge, calculate the public offering price. We're working on $9.15. 100% minus 7% is 93% or 0.93. And let me now, boom, get out Dean's calculator. Oh, by the way, this is the same calculator they provide you on the test. Are we clear? This is a simple function calculator. So, if you're not used to, I'm not being facetious. If you're used to a financial calculator, maybe you want to buy one of these $3 ones just to get used to using a simple function calculator. All right, so 915 divide by 0.93, $9.84, Philip. And paying $9.84 is better than paying $10. I wish other businesses.
Question on that.
Yep, hold on. I wish, Philip, other businesses were like ours. Sometimes I'll say, is there any deal I don't know about? And they go, what do you mean? I said, well, in our business, we got to tell Philip how to get the best deal. Right? So I say, hey, Philip, I know a way you can get the fund for 7 instead of 8.5. And that's called a breakpoint. And we will be talking that at length in just a moment. Yeah, Micheline, what do you got?
Full disclosure.
No, so if you're doing 100% minus 7% and you divided it by the 93, would that be 93% or just
the same thing? It would be the same math. If I take $9.15, right? If you have 93 cents of a dollar, that's the same thing as 93% of a dollar. Okay. So, all right. So again, this is how mutual funds get sold. Mutual funds get sold with this model here. Right?
Dean?
Yeah. Yeah, Christina. Yep.
I'm kind of, hi, good evening. I'm kind of confused with the very last one that we did. Yeah, this one. Because there's 3 things. There's the sales charge, the NAV, and then the public offering price.
Yeah, we said, let's go all the way back. We said there are 2 scenarios on the test. One scenario is when given the NAV and the public offering price, calculate the percentage sales charge. So as a test taker, you say, I know this scenario here. They're giving me the NAV. They're giving me the pop. I need to figure out the percentage sales charge. And I know if I come up with more than 8.5, it's not an open-end fund. It is a closed-end fund. So these are our 2 formulas I suggest we memorize. So here's our formula for determining the percentage sales charge. We take the POP, public offering price, minus the NAV, and we get our sales charge of 85 cents. That was given information. So the test, I say a mutual fund has an NAV of $9.15, a public offering price of 10. What is the percentage sales charge? You say it is going to be 8.5%. I'm very testament of that's the legal limit. I say your customer qualifies for a reduced sales charge of 7. A reduced sales charge of 7. I just made that up. What is your client's public offering price? And we should know, if they give me an exhibit, that in this example, you're not going to be paying 10, because 10 is for somebody who's paying the full load. The way we do this is we take the NAV, this is our second scenario. We take the NAV, boom, and we divide by 100% minus the sales charge. In this example, the sales charge is 7%. You always do in math, parentheses first. That's called the order of operations. You know, how you do things in order. Almost always, Christina, when somebody says, Dean, I'm not getting the same number as you're getting, it's because they're not doing the order of operations correctly. Now, this is a math review. What's that, Philip?
PEMDAS.
Yeah, there's a memory aid. It sounds like Philip knows the memory aid. What is it, Philip?
It's parentheses, exponentiation, division, multiplication, addition, subtraction.
There you go. So, you know, I don't think we need that to pass FINRA and NASAA. But I do think we should have a general understanding. So when you're messing up on the math, it's usually because you're not doing the order of operations correctly. So here, we're going to take the 100% minus 7, and then we're back in business, right? Because then boom. Now, you can express that however you want. You can express that. That's the challenge with math too, Christina. There's a lot of different ways to do math. I could have just as easily taken 1 minus 7%, because 1 and 100% are the same number, right? So I could say that's 93%, you know, however I want to do it, as long as I come up with 984. Now, I did that on the fly. Are we all coming up with 984? I hope we should, you know.
Yeah, I came up with 984. Question for you. Since it's the same 3 variables, both of them have sales charge, both of them have NAV, and both of them
I'm always giving you 2 and asking to solve for the third.
Exactly. Yeah. Isn't there like one equation that we could just plug in numbers for both? Because these look like 2.
I don't know. There is. Share it with me. I don't know. And I'm better at my math. Math it's a buffet. Take what you like. I'm always better when I do math to know my scenarios and know what tool I'm going to use. Now, I had a guy, Christina, I probably told you the story, and I hit the button on the Zoom for the tutoring, and he goes, Dean, I'm not paying you $225 an hour to do math with me. I can do any math. You don't need to tell me formulas. Give me any 2. I can solve for the third. And, you know, hey, more power to him. By the way, he did pass, but when he passed, he said, Dean, you know, I got a little bit of hubris there, a little bit of, you know, pride. And a lot of times they'd ask me just the formula and not to do the math. And I struggled a little bit because I was able to figure it out because I could make it up and do it and then say, oh, yeah, that's the formula. But he said, I wish I just had the formula. Say, okay, I know what I got to do when I get this formula. I think, Christina, we're doing a mutual fund lecture tonight, but I consider it to be the same thing on calculating parity. You just got to practice and drill and rehearse so much that you go, okay, I got it. I got the conversion price. I need the ratio. I take the current market price, divide by the number of shares, right?
Right.
Yeah, you should always round up, but it will never make a difference on the test, right? So I'm rounding the 3 to 4 because it's 5 or higher, but on the test, where you put that decimal will not matter. You would pick what approximates your LED display. All right, so here we are with our fund. I told you that I used to sell, when I was a baby broker, a lot of the Franklin, California tax-free fund. Now, that was kind of my go-to move. I'd say, hey, doctor, are you interested in tax-free income? You know, hey, Mr. Car Dealer, are you interested in tax-free income? You know, well, as I told you, the underwriter, sponsor, or distributor for that fund is Franklin Templeton Fund Distributors. And, you know, Franklin Templeton Fund Distributors is a FINRA member firm. And they have men and women whose job it is to go help you sell their fund. These men and women who work at Franklin are associated persons, and they work at American Funds has these folks, BlackRock has these folks. And I got to tell you, what's that?
These are like wholesalers.
That's what they're called. The reason I bring that up is because I used to tell my baby brokers, Christina, why don't you call our wholesaler? Why don't you go look at our approved product list and see all of the different funds we can sell and have them take you to lunch and, you know, see what fund you might want to use as one of your go-to-meet people kind of opportunities, right? And then so here's lots of places you can get the Franklin funds. You could get this from like Edward D. Jones. I guess Edward D. Jones, I just saw their commercial the other day. I was very surprised that they don't want to be Edward D. Jones anymore. I guess they're just Edward Jones now. I was like, what? You know, I hate it when people do that. You know, I had this guy telling me about his firm. I said, man, that sounds like the Lutheran Brotherhood. And he goes, well, now we're not the Lutheran Brotherhood. I forget who they are now. It's like, you know, everybody's always changing their name. You can get this from Merrill. You can get this from Morgan Stanley. You can get this from UPS. These are what we call selling agreements, right? As I said, if I'm a UBS broker, here's my investor. And you say, Dean, I want to invest $10,000 into the Franklin, California tax-free fund. And that check is going to be made payable. That check for $10,000 is going to be made payable to Franklin Templeton Fund Distributors. So we're going to send that off to Franklin. Franklin's going to get the check. They're going to cash it. And the load in this case is 4%. And then that means after they cash it, 9,600 goes into the fund. How many shares are you going to get in the Franklin, California tax-free fund? I don't know. I don't know until we do the what? Next.
Calculation of the NAV.
Yeah. So I come out to you and I say, hey, Christina, what would it take for you to sell my fund exclusively? And Christina says, Dean, to the detriment of my firm and its clients, I say, if need be. And Christina, you know, I carry around a money clip, and my money clip has a whole bunch of $100 bills. You know, that's how I roll in Vegas, and there could easily be, you know, $5,000 on that money clip. And I say, Christina, I'm just going to start putting out $100 bills on your desk here, and you tell me when. And, you know, I get up to, you know, $1,500, and she says when. Okay, so now it's debatable whether Christina represents her firm and its clients, or whether she represents me in an effort to defraud her firm and its clients. Very testable. What is the maximum gift or gratuity that an employee of one member firm, the fund distributor, sponsor, underwriter, can give to the employee of another firm? $100, right? Now, remember what this doesn't count? I say, Christina, why don't you invite your prospects and clients to a seminar this evening? And I'll come talk about professional management, diversification, ease of ownership, and I will pay for the pizzas and the sodas. And those pizzas and sodas could be way north of $100, not a problem, right? Doesn't count normal deductible business activities. So you can't sell things that you don't have a selling agreement with your firm, right? If you sell things not sponsored by your firm, that too is a big violation. That's called selling away. You can't sell shares for less than the NAV. And we said, if your customer comes on hinged, or right, has buyer's remorse and redeems within 7 days, we're not going to give you the commission. Because we're going to say, well, wait a minute, you know, you didn't do a good job presenting the mutual fund as a long-term investment. Breakpoints are quantity discounts. Very testable. And here is an exhibit. An exhibit. We love exhibits on the test. Why do we like exhibits? Because we know the answers there. We just got to what? Dig it out. Right? So you say, Dean, how much money should I invest? And I say, you want to invest $49,999. And you say, why? I say, because I'll make $4,250 in a commission. And if you give me another buck, I'm only going to make $3,000. Am I a full service broker, or B, violating the code of conduct?
Breakpoint sale.
Yeah,
Bye,
big no-no, right?
nation.
So be careful on your reading. RTFQ, breakpoints are good. Breakpoint sales are bad. Breakpoints are good. Breakpoint sales are bad. So should we, let's say you say, Dina, I only have $30,000 to invest. So it looks like with $30,000, you're not going to get the breakpoint. I say, well, listen, do you think you might be able to come up with another 20? So your initial investment is $30,000. I say, do you think that within the next 13 months, very testable, you might be able to come up with another 20,000? Because if so, we should fill out a letter of intent. A letter of intent is good for 13 months, very testable. It can be backdated 90 days. So, you just get your 6 and your 63 and you're kind of excited, get your SIE and you got your first client and you come in, I'm your supervisor and you're all excited and you're telling me you got this $30,000 investment. I said, did you tell them about the breakpoint? Oh, Dean, man, I got so excited I forgot. So you forgot the thing about the letter of intent and all that. Yeah. So, well, no problem. Good news. The LOI can be backdated for 90 days. So no harm, no foul here. That 90 days is inclusive of the 13 months. So I call you back 30 days later. I go, what's going on with this letter of intent? You said, I'm trying to track them down. I said, well, you need to get them because now we only have 12 months left. That 90 days is inclusive of that 13 months. So if you wait 90 days, you got 10 months left to get this done. Now, as I said, the customer can't be hurt because in my example with Philip paying 7 instead of 8.5, he's going to buy additional fund shares. That's a wonderful thing, right? And then we're just going to escrow those shares, Philip. And if you don't fulfill the letter of intent, we're just going to back flag the account and it'll look exactly how it would have looked. I had a guy who is a mutual fund supervisor at this mutual fund company. He said, Dean, it wasn't suspiciously close to the break point, but it was close. And so I waived it for him. I said, well, that was nice of you. He goes, Dean, you won't believe what happened. The rep on the account called and cussed me out and said, how dare I waive the break point and reduce his commission? And he said, well, don't you realize I gave your client more fund shares? He said, well, Dean, I wasn't suspicious, but then I thought, well, maybe I should pull some more apps. And a pattern did emerge, and he was doing Breakpoint sales. So Philip says, Dean, there's no way I'm coming up with another 20. I'm just not. I say, okay. Do you think over your lifetime you might come up with 20? He goes, I hope so. I said, well, let's at least get you rights of accumulation. With rights of accumulation, you're not getting the reduced sales charge on the 30. You're paying whatever that load is, in this case, 8.5. But when you do cross the break point on that and all subsequent investments, you get the reduced sales charge. Sometimes I get, they won't test you on the calendar days, but it's calendar as you see here. It's calendar days. They're usually done automatically at most funds, but on the test, we assume you're going to have to tell the customer about the differences. Just because of accounting, it's difficult. People say, Dean, if I buy more tutoring hours from you, do I get a reduced charge? And I always crack up. I go, oh, sure. You're asking, do I have breakpoints? I said, unfortunately, I don't, just because of the accounting, but I have a young lady I've been working with, and, she's invested some serious money. And I said, I'll tell you what, I'm going to have rights of accumulation. I'm not going to give you the reduced sales charge up front. You can't tell me you're going to be a good customer and I treat you as that. I go, no. But when you do spend X number of dollars, and I told her this morning, you spent X number of dollars with me, the next session's on me. So that's, Breakpoint. I didn't give it to her up front. She had to earn it. I had a guy in a coffee store in my apartment in San Francisco, and he had rights of accumulation. I buy 9 coffee cups from him. He gives me the 10th one free, rights of accumulation. I said, hey, let's go to a letter of intent. Why don't I agree? I'm going to buy 9 and you give me the free one up front. He goes, well, Dean, how would I make sure you fulfill it or back flag it? I go, I don't know. I haven't figured that part out. Anyways, one day I forgot my wallet and he said, Dean, this one's on me. We're going to do it the way you wanted to do it. So I'm giving it to you up front. So I think of it as a letter of intent. You tell me you're going to be a good customer. I treat you as such. Rights of accumulation, prove it. You prove to me you're a good customer. And by the way, it's when you cross all of that investment, even you make it by the hair of your chinny chin is going to be at that reduced sales charge.
I got a question.
Yeah.
So the backdate is also for like verifying that you didn't do a breakpoint sale. Like
No,
who's it?
it could also be maybe you
Or is
didn't.
it also like if I spent like 60 days and I still don't have
That's
the
fine. No, maybe for
Okay.
example, another scenario. Philip says, Dean, no way I'm coming up with the 20 grand. I go,
Okay.
okay. And he does rights of accumulation. Then he wins the lottery. He says, damn, Dean, I should have done it. I said, well, it's not too late, my friend. It can be backdated what? 90 days, right? They do, Philip, the reinvestments of dividend capital gain. So the way I think of that, Philip, is with letter of intent, it can't be money we've made you. It's got to be fresh, new money you're investing in the fund. With rights of accumulation, your reinvestments of your dividends and capital gains do count. All right, investment clubs. Yeah.
One other question before we move on from this. As far as the 13 months are concerned, is it very testable for them to go beyond the 13 months
No.
and then ask you like what happens at that point?
No.
Okay.
I've never had anybody ever tell me they've seen a question like that.
Wow.
Any person may receive breakpoints except investment clubs. Test question, investment clubs are not allowed to pool their purchases for purposes of meeting a breakpoint. A combination privilege. A lot of mutual funds like Franklin, at Franklin, the breakpoint was $100,000 or more. I don't know if that's still the case, but you would pay 4% up to 100. 100 or more, you pay 3. And Franklin would say, we have a combination privilege. We don't care whether you do that at different broker dealers, different accounts, your spouse, however you get there. So combined combination privilege allows you to combine your purchases for purposes of meeting the breakpoint. That varies from fund to fund as stipulated in the prospectus, but it is one of the advantages of doing business with a fund family, like American funds or Franklin funds or whatever it happens to be. And then we said very testable, the breakpoint sales are very much testable, and it's a big no-no. Or breakpoint sale, breakpoints are good, breakpoint sales are bad. So it's not good when you pass your exam and you go to your manager and say, you know, I want to sell dividends, do breakpoint sales, open fictitious accounts, do some front running, do some churning. You know, I want to sell away. Those are all bad things you're not supposed to do. I pulled this question from the FINRA SIE practice exam, and I like it. So I pulled this question. Chat is open. What do you think the right answer to this question is? Under normal circumstances, a customer's letter of intent on a mutual fund purchase is valid for what maximum period of time? Oh, A is a bad miss. B is a bad miss. It's 13 months. 13 months. Letter of intents must be fulfilled within 13 months. Very testable. Very testable. Now we have other share classes besides A shares. We have B shares. Very testable. The suitability for a B share is somebody who has a smaller amount to vest and a long time horizon. Mutual funds are supposed to be for the long term. For the long term. And so I say, listen, if you'll stay in the fund for 5 to 7 years, not testable, we'll turn your B shares into A shares. Wow, be careful on this one. On debrief today, somebody had told me they'd seen a question that was something like this. I like this question. Well, your point, Micheline, it depends on the breakpoints. They don't ask you how it's so smaller. It's a judgment thing. The idea is larger, you would get the breakpoints. And so it'll be given information. But let's say it's a bond fund and interest rates go up. So you go for the B share in the bond fund, interest rates go up, the NAV goes down, and now you redeem. And now you're going to be assessed that sales charge. So here it could be the most expensive option if the customer doesn't understand this idea that they need to waive that sales charge. You know, otherwise it's going to be more expensive than even the A share or a C share, right? The other test question here is misuse of no load terminology. You know, it's kind of like if I went into a nightclub and they say, Dean, there's no cover and there's free valet parking. I go, wonderful. And then I go to get my car and they say, Dean, there's a $40 exit fee. And I said, well, you told me it was free. And they go, well, we told you there was no cover. and free valet. If you go back in there and do another bottle service, we'll waive that for you. So the idea here is we're going to waive it if you stay in for a lengthy period of time. So B shares, as I told you, most funds don't even offer these anymore because it's too confusing to customers. A letter of intent, aim and shoot, point and click, Ethan. And letter of intent is good for 13 months. That's just an aim and shoot, point and click question on your exam. If it said how long you can backdate it, then it would be 3 months or 90 days, right? That's a definitional question. That's an aim and shoot, point and click question. C shares. C shares have a 12B1 fee. And if we are going to have a 12B1 fee over the life, that can't be test question more than 0.75%. A 12B1 fee is a promotional expense. A promotional expense. It's not a function of managing money. It's a promotional expense. And I think it makes sense when you think about it. I told you, for example, the Franklin Fund has a 4% load for the A share. And if you go into a C share and you're paying 0.75%, at the end of what, the 6th year or 7th year or the 8th year, you would have been better to pay the 4% once and be done with it than to pay it for all of eternity, right? So that makes sense. These are going to be suitable for a shorter time horizon because, again, over the longer term, you'd better to pay the load and be done once. Truly no load funds, shares like Vanguard, their max that they can charge as a promotional expense is 0.25%. That too is testable. Vanguard doesn't do that, but boy, can you imagine what boatload of money that would be at Vanguard if they started charging 1% on the trillions of dollars that are over at Vanguard? Woo! And as long as they don't go past 0.25%, then they can still refer to themselves as a no load fund. And in a no load fund, the money goes right into the fund, right? So there's Vanguard no load fund, and there's nobody taking any of that money. Now, boom, and it goes right in there. Right. So here the investor has 10,000. Remember in my previous example, the 10,000 isn't going into the fund. The $10,000 in my previous example was going to the fund distributor. They were cashing the check. They were taking 400,000 out, $400. Can that no load fund charge a promotional expense? Certainly can. Now, one of the disadvantages of a mutual fund is you give up tax control of your investments. You give up tax control of your investments. If we didn't have subchapter M or the conduit or pipeline theory, what would happen is the corporation, ExxonMobil, for example, would make money, pay taxes, pay a dividend to the mutual fund, and the mutual fund would pay taxes. And then the mutual fund would pay me a dividend and I'd pay taxes. My God, that money would get taxed 3 times. The IRS has been kind enough to say, under subchapter M or the conduit or pipeline theory, that as long as the mutual fund passes through die 90, I think a good way to remember this is with the memory aid die 90. As long as they pass through 90% of the dividends on the stocks in the portfolio, plus the interest on the bonds in the portfolio, less the expenses, the IRS will wait and get that from the individual shareholder. Well, no, it is not common. The question Michael has, for those of you watching video replay, I don't think I put the chats on the video replays. If I do, it's unintentional. And so if you do join us like Michael does, you put something in the chat, you should probably know it's maybe compromised. Anyways, Michael's question, is it common to be tested on calculations? Now, it drives me nuts, Michael, test prep vendors who get so in the weeds making people do stuff that I know they're never going to see on their exam. And some test prep vendors, Michael, are more guilty of this than others. So I've never had on debrief told me somebody had to calculate this. Now that varies from exam to exam, but no, just a general understanding. There's an investment, Michael, very testable that's very similar. It provides professional management. It provides diversification.
REIT.
Well, gee, look at that. Now, Philip is front running. Right? He's correct, right? But it's not a diversified portfolio, Philip, of professionally managed securities. It's a diversified portfolio of professional managed real estate. And both Philip and Michael were correct. This is a REIT. And I would know that a REIT, it too must pass through what?
90%.
There you go, right? Be careful here. Mutual funds and REITs don't pass through losses. They just pass through income. The only investment vehicle that passes through both profits and losses is
Partnership.
right on. Partnerships, LPs, right on, Tanya. Right on. Okay, so as I said, one of the disadvantages of a mutual fund is you lose tax control of your investments. A lot of mutual funds say, listen, if you don't need the dividends, you can reinvest them into the fund. Those are called DRIPs, very testable, a dividend reinvestment program. And, you know, I'm pretty blessed. I say to the mutual fund, I don't need the money right now. So whatever you were going to send me, just buy me additional shares. You know, I come from humble beginnings, and, you know, this is back in the day before there were things like Robinhood. And when I got started buying securities, what I would do is enroll in ExxonMobil, Chevron, Anheuser-Busch, what they call their dividend reinvestment programs. And what I would do is send them a couple $100, and they'd buy me some shares, and I'd say, buy me some more with the dividends. Whether it's a mutual fund or a stock, when I get 100 shares, I have them send it to me, the round lot, and then I put it in my brokerage account. So that's how the beginnings of Dean's brokerage account was, doing these optional cash payments and these drips until I could get, you know, normal unit of delivery, which seems odd today, right? Because now I think, you know, in the old days, you couldn't buy fractional shares, and now you certainly can. Anyways, long story short, the IRS says, Dean, as far as we're concerned, you could have got the money. And that's the same as getting it. That's called constructive receipt. That's the tax concept that whenever somebody says, do you want money? And you say no, the IRS says, well, you could have said yes. And that's the same. So I'm going to get 1099. I still owe taxes on this. So the reinvestment of those dividends, I still am going to pay taxes on them. And that is a testable concept. This idea, the drips, the reinvestment, the dividends are taxable, whether or not you receive them. Received or reinvested, still taxed. You know, if you get stuck on a tax question on your exam, always pick whatever yields the most to the U.S. Treasury. Whatever yields the most to the U.S. Treasury is usually the right answer. Now, we're assuming the mutual fund is in your 401k or your IRA. We're talking about a mutual fund in your personal account. The capital gains tax is a transaction-based tax. And the easiest way not to pay it is not to transact. You know, Fidelity bought 10% of Google at the IPO price of 85, and they still own 10% of Google, Alphabet now. Wow. They have tens of billions of dollars in unrealized gains in their portfolio, unrealized gains, because they haven't sold the Google. Now, if I had the Google Alphabet stock, I might say, you know, my investment mind says sell, but my tax mind says, oh, I'd have to pay a huge tax. And so I think I'll just keep it. But in a mutual fund, you don't have that decision. The manager has that decision. And so when they realize the gains and sell the securities, that's going to be distributed to you no more than annually. It's taxable to the investor at the capital gains rate. Why? In my example, Fidelity's had that for more than 12 months. Right? So the holding period is based on how long the mutual funds had the security. Short-term or long-term is the holding period of the fund, right? Just like we would be for individuals. Now, when you redeem, that too is a taxable event. Whether or not You go from the growth fund to the money market fund. That's going to trigger a taxable event when you redeem the mutual fund. And that will be taxed at either short-term or long-term based on how long you've had those fund shares. And then remember, the redemption is based on the next calculation of the NAV. So we don't know how many shares you're going to get. You know, maybe I've been doing fixed dollars invested regularly. That's called dollar cost averaging. And so I have been accumulating shares over different time frames. And now I want to sell shares. And what I'd like to sell is the shares I have the highest cost basis on. That's called share identification. Or I could just multiply, I'll show this to you in a minute, and take the average. But typically the shares I bought first are the shares with the lowest cost basis and would generate the biggest tax. And so if I haven't kept good records, test questions, the IRS is going to impose on me first shares bought, first shares sold. Why? Because that will generate a bigger tax. Right now, you get to elect. You can choose how you want to do it. But I can't tell you how many times tax reform is proposed that progressive members of Congress say, maybe that shouldn't be an election. Maybe we shouldn't make people go FIFO. And then I see how many billions that would bring into the U.S. Treasury. Right now, you can do it any way you want. If you don't keep records, you're going to get imposed FIFO. I picked out another good, I think, practice question from the FINRA exam. So this is another one I think was pretty good from the FINRA practice exam on their website. The redemption value of an open-end mutual funds company shares is based on anybody want to give that one a try?
C.
Yeah, it's got to be C. C, the next computation, right? Forward pricing. We're never doing value business on the previous. It's
redemption. Sorry.
Right? It's always the next one. DRIPs, no, just the dividends, whatever they pay. And it's, you know, up to the board to declare a dividend. The board of directors declares the dividend whenever they declare it. Stocks, it's quarterly, but mutual funds, whatever they decide. Okay, so here's an example test question of dollar cost averaging. And there are 3 test questions about dollar cost averaging. What makes it work? Fixed dollars invested regularly. So you can see here in this exhibit, I've got a customer who's agreed to give me $100 every quarter, let's say. So that's test question number 1. What makes dollar cost averaging work? Fixed dollars invested regularly. This is a great way to invest because most people don't get like 10, 20, 30 grand, but a lot of people can invest in drips and drabs where they get $100 or $50 a month. So it's easier. By the way, you're doing exactly what you should be doing here, which is buying less shares when they're high and more shares when they're low. Test question number 2. What's the end result? You'll end up with a lower average cost than those of the underlying shares. Test question number 3 doesn't guarantee a profit. There are 2 nasty words we should never use in the securities industry, and those are guarantee and
Guarantee.
Mm.
So let's say the public offering price is 10, we get 10 shares. Oh, what a value. Now it's 5, we get 20 shares. Right, we're doing exactly what we should be doing. Buying more shares when they're low and less shares when they're what? High. And so now test question number 2, right? The average share price here, if we add up 10, 5, 10, 5, 30 divided by 4, the average share price is $7.50. Now remember what we said the end result of dollar cost averaging would be? We'll have a lower average cost than the underlying shares. So $400 is what we've invested. That $400 has bought us 60 shares. And so our average cost divided by 60 is 666. Test question number 2, we will end up with a lower average cost than the underlying shares. Test question number 3, please note we have 60 shares valued at 5. So right now, this is a $300 account because we have 60 shares of this fund that are presently valued at 5. Now, outside of the testing fantasy land, You'd be hard pressed to convince me that anybody who's dollar cost averaging in a mutual fund or any lengthy period of time is not going to do okay. I mean, most people get where they're going without crashing and burning are people who have been dollar cost averaging mutual funds. You know, John Bogle, before he passed his last book he wrote, I thought it was nice. In the back, he had an appendix of people who had been in the Vanguard fund since he started them dollar cost averaging. They stripped the account and they had millions of dollars. Then they were just getting the market-based return. They weren't even, getting more than the market. Is this going to be more so a recognition question, or we'll have to solve? I think it's recognition, but every once in a while, so low probability, Ethan, that you're going to have to do an example of this. So mainly, as I said, your point, I think I would recognize dollar cost averaging, what makes it work, fixed dollars invested regularly. What's the end result? It doesn't guarantee you profit. Might you have to do the math? If you do, it's simple average math, right? So perhaps. All right, well, let's talk about suitability. There's truth in labeling. So, boy, in our business, you better be able to say in your sleep, past performance is not indicative of what? Future results. I got to say, hey, my crystal ball is broke. I don't know anything about the future. But what we're trying to do is match the investment objective of my investor with that of the fund, right? This is kind of like tender for mutual funds, right? Are we going to swap right? We're going to swap left, right? So, you're into growth. We have a growth fund. You're in income. We have a fund that buys stocks that pays dividends. You're into growth and income. You're into total return. We have a fund that does that. Tax-free income, index funds. Index funds are testable. And, sometimes a customer might say, they'll give you R on the test where the customer says, Dean, I think trying to outperform the market is a waste of time and resources. I'd be willing to accept a market-based return and would like a lower cost structure and tax efficiency. I said, there's a lot of people who believe in that. In fact, that's called the efficient market hypothesis. That, this idea of trying to beat the market is a waste of time and resources. And then again, the test question, we recommend an index fund. Another concept about an index fund is it would have a beta, if it's an S&P 500 fund, for example, of 1. Right, so the S&P 500 index fund has a beta of 1. 1 means is a measurement of volatility as compared to the market. So market goes up 10, this fund should go up 10. Yeah, the test is prejudicial, Tanya. They have passive investing. I saw a guy from Capital Group. It's a great interview. And he was, David Rubenstein was interviewing him about active management. And it was the best presentation of active management I've seen in a long, long time. And he was saying, listen, 85% of our strategies outperform our benchmark. We don't apologize for being active managers and trying to find alpha, excess return over beta. And, then David Rubenstein kind of pushed him and we said, you don't hear that too much anymore. All you hear is about passive investing. He goes, well, it's harder for us to articulate, to be honest with you. I mean, it's hard to explain it to folks. But I thought he did a good job. I was impressed. I hadn't seen that in a long time. A specialized or sector fund test question are the most volatile funds we have because they're diversified, but only within that specialty, that sector, right? I gave you an example of a specialty fund, the Mexico fund. It's diversified, but only in what? Mexico, right? So money market funds, very testable. Very testable. I say, what would you like to do with your idle cash? A beta higher than 1 means more volatile indeed, Ethan. A beta of 2 would be twice as volatile. I thought this was funny. This guy does luncheons and seminars for employees who have their 401k with his fund distributor, his fund family. He said he was doing a luncheon seminar. He said, Dean, this guy came up at break and said, he wanted to retire in 5 years. Which fund should he pick? And I asked him how much he'd put aside so far. What is the present value of what he has to invest? And he said he hadn't even started yet. And I said, well, what'd you tell him? He said, I told him he ought to buy a lottery ticket because we don't have a fund that has a high enough beta to get him from here to retirement in 5 years. So Ethan, that also comes up. I've used that one when I was a practitioner, saying, Ethan, this portfolio, this mutual fund, or the portfolio I've created for you, either one, has a higher beta. We're taking a little more risk, but unfortunately we need to, because our time horizon is not quite what I'd like it to be. I wish we would have started a little sooner. Or, hey, there's no sense in taking extra risk if we don't have to. Now, very testable. What do you want to do with your idle cash? We have traditional bank accounts, but we also have a money market fund. And you say, Dean, what's on a money market mutual fund? I go, oh, that was on my test. High quality debt maturing in less than 12 months. And they say, like, what? They say, oh, that was on my test too. Like T-bills, commercial paper, bankers' acceptances, negotiable jumbo CDs. And they said, well, hey, what's up with commercial paper? You said, that was on my test too. Commercial paper is large unsecured buying by corporations with a max maturity 270 days and is issued at a discount, like T-bills. They said, well, T-bills are better. I go, well, in terms of credit quality, there's no better money market security than a T-bill, because it has no credit risk. You say, hey, what about bankers' acceptances? I go, oh, that was on my test too. Those two were issued at a discount. Those two have a 270-day max maturity, and those are used to facilitate foreign trade. Well, Philip, by rule, we can't let you go over 13. By industry, it's 12, but because people were cheating, we said, okay, well, let's just define it legally as 13, but it's a year. You won't get to 13 months. That's a requirement we posed on money market funds for cheating and buying intermediate securities and then having a higher yield, attracting more money. So, anyways, alpha is excess returns over beta. And not prediction. I don't like the word prediction, Ethan, particularly as it relates to mutual funds. But we have an expected return. That's more about portfolio. This is a lecture on mutual funds. Someday join me for analytical methods. We'll talk about that. Anyways, onward and upward. Bankers acceptance used to facilitate trade. Negotiable jumbo CD. What's the denomination of a jumbo CD? 100 grand. And negotiable means it can be traded. Makes sense because we got to meet redemption requests. Various types of funds we have. We're talking about the various types of funds we have because we're trying to match our investor to that fund. And we also have balanced funds, stocks and bonds. We have asset allocation funds. We have bond funds, very testable. Bond funds are the one time the fund can actually be more dangerous than the individual securities. Because when you own individual bonds, you can choose to hold them to maturity. But in a bond fund, if interest rates go up, the NAV goes down. Right? So you have a corporate bond fund, a government bond fund, a municipal bond fund, and you've had that for more than a couple of years, the NAV is lower. Why? Because interest rates have been going up, causing the bonds in the portfolio to go down. And so bond funds have interest rate risk, just like the individual securities themselves. You can diversify away from the credit risk. You can't diversify away interest rate risk. Any bond fund has interest rate risk. So we have corporate bonds, government bonds. We have muni bond funds. Muni bond funds typically have a lower yield because they're typically safer, and they have tax advantages. The only component of a muni bond that is tax-free is the interest. Right? If the manager sells a muni bond high that he bought low, that capital gains distribution to you is indeed taxable. How do you decide whether the customer should buy a taxable corporate bond fund or a muni bond fund?
Marginal tax bracket.
Remember, that's exactly right. You either take the taxable yield and times it by 100% minus this tax bracket to get the tax-free equivalent, or you take the tax-free yield and divide. Separate issue than we're discussing this evening in this lecture, but it is suitability. So muni bond fund would be attractive to somebody in a high tax bracket. We talked about money market funds, and we said a money market fund has a fixed NAV of $1. They're no load, and you can write checks against them. That's where you put idle funds. We have mortgage-backed securities, and therefore we have mortgage-backed securities funds that buy Ginnie Mae's and Fannie Mae's and Freddie Mac's, those kind of things. Suitability, always important. I say for me to do a really good job for you over time, I need to know a lot about you. The more I know about you, the better I'm going to be determining suitability. You know, what is your investment objective? I say, hey, I'd like to read you a list of investment objectives. I'd like you to rate them on a scale of 1 to 10, 10 being very important, 1 not important at all. You know, safety of principle, 10. Tax advantage, 10. Income, 10. Maybe I buy you a muni bond fund, right? So that's just an example of that. You know, everybody does it a little differently. An investment style you're comfortable with. So, you know, we have value investments where we try to do fundamental analysis, have a margin of safety, buy stocks with low PEs, high dividend payout ratios, close to price to book. We have growth funds where we're buying stocks at a higher PEs, little to no dividends, and we'd be in that for price appreciation. Can we talk about a fund's past performance? We can. So what had we better say? Past performance
not indicative.
It's not
Christina,
indicative
is
of
it?
future results.
Yeah, isn't it? It's only our industry that's like that. When you think about it, I mean, when I look at Anthony Edwards, that young man playing basketball, I go, you know, his past performance is indicative of his future result, right? Or see LeBron out there? Oh my God.
Tiger Woods.
There you go. Well, Tiger, I was just going to bring up LeBron. LeBron hasn't yet aged like Tiger's aged, right? But at some point, Father Time wins. I mean, I just, when I watch LeBron, what is he, 40 years old? And he playing with those teenagers and he's still out running them and dunking on them. I'm like, man, incredible.
Our basketball guy.
Yeah. But in our business, right, we say, hey, LeBron's past performance is not indicative of his future results. Sales loads, important. You know, not the determining factor, but it's one of those things, right? Expense ratio. Again, this is the monkey banana thing, how much money gets eaten up in expenses. And then tenure, either good or bad, right? Tenure could be good. We have a legendary guy, Bill Gross, who started the PIMCO mutual fund family. And at one time, his fund was the largest mutual fund in the world. And, you know, when he quit and walked out, they received $38 billion in redemption requests. These are people who said, hey, if Bill's leaving, I'm leaving. Now they're based on his tenure. Or you say, hey, the tenure is pretty bad. I go, well, hey, that was the old guy. We got rid of that guy, and now we got a new team or new person. So tenure, either good or bad, is important as well. We said ease of ownership. You can choose different funds. It's convenient. You have liquidity in a mutual fund, guaranteed marketability at the NAV. We said you have low minimums. Some funds offer you combination privilege. Some funds have an exchange privilege where you can go from fund A to fund B with no sales charge. Is that still taxable if you take advantage of that exchange privilege and you get out of the growth fund and go into the bond fund and they waive the load for you? Is that still taxable?
Yeah. I would assume so.
Absolutely. Absolutely. What do you have in terms of risk? Well, you have market risk, right? Systematic risk. Market risk prevails despite diversification. You have interest rate risk if it's a bond fund. That can be diversified away. You have expense risk, and you have tenure risk. The tenure risk, again, is the team that's managing the money leaves. I like this. I took this from the SIE practice exam. Which of the following responses describes the advantage of an index mutual fund?
D.
Yeah, right on. D is in dog. D is in dog. By the way, as a test taker, I know it's either C or D because they say opposite things. So I don't need to burn up brain cells on A and B. I got to take A and B. Right. So, you know, it's just a test taking trick called the principle of mutual exclusion. When I have two answers that are opposites, it's got to be one of the opposites. Right. Socrates is a dog. Socrates is a philosopher. He can't be both a dog and a philosopher. He's either a dog or he's a philosopher. Which of the following communications with the public is considered misleading? Historic illustrations based on factual performance. That sounds okay. Product comparisons that illustrate material differences. That sounds okay. A research report that includes a buy recommendation for specific security. Sounds okay. Literature providing 10-year performance to predict the future.
D.
Oh, can I predict the future?
Go predictions.
If I could, I wouldn't be here on a Friday night with you folks.
Although you would want to.
There you go. There you go. I think I forget who it was, whether Ethan or Michael or somebody was asking about the ETFs. This is very testable. You know, the test is always about contrasting. So as a test taker, you don't want to be able to compare things. You do, but the contrasting points are the more testable points. They test you more on how things are different than how things are alike, right? So ETFs versus in individual. Open-end funds aren't continually priced. Remember, we said they're doing business based on the next calculation of the NAV. Some people don't like that. ETFs, test question, are continuously priced. So that's one testable distinction. ETFs, like closed-end funds, trade like a stock, supply and demand. Reg T, Federal Reserve Board. Reg T is a part of 34. Prior to 1934, we, as broker-dealers, were in charge of credit extension to our customers. And when we were in charge, I lend you money to buy anything. What do I care? That was called the Roaring Twenties. And at the end of the Roaring Twenties, there was a crash. And we decided maybe broker-dealers aren't the best decision makers about credit extension. And we took it away and gave it to the Federal Reserve Board. And the Federal Reserve Board says that new issues, test question, are ineligible for purchase on margin. It's considered a new issue 30 days from the effective date. Open-end funds are continually offering new shares. Therefore, you can't buy them on margin. ETFs, you can buy on what? Margin. Another testable distinction. You can't sell short an open-end fund. You say, man, those damn guys don't know what they're doing. I wish I could sell short that open-end fund. You can sell short an ETF. For test purposes, when I say for test purposes, that means I'm telling you, I know that outside of the testing fantasy land, the real world is different. And good news, you men and women will re-enter the real world someday. You get to pass your exams, exit fantasy land of testing, the testing fantasy land, into the real world. I'm stuck here permanently. No wonder I'm demented. So when I say for test purposes, that means I know that that may not be true outside of the test. But on the test, ETFs are passively managed, whereas open-end funds are actively managed. Now, that leads to two things. ETFs typically have a lower cost structure than an open-end mutual fund. And since they're not buying and selling securities, they're more tax efficient. Right? So very testable. All exams are going to test you how are open-end funds different than closed-end funds? How are ETFs different from open-end funds? Now, we also get tested on what are called ETNs, exchange traded notes. Wow, this is a lot less work. You know, an ETF is an equity investment. There's a custodian that's holding the monies and securities. A lot of work. You know, BlackRock knows how to do this. Vanguard is in this State Street. So I decided instead of setting up an ETF, instead, Christina, as a bank, I'll give you an ETN. I'll promise, Christina, to pay you whatever that index does. You don't need to buy an ETF because I'll just pay you whatever it is. So you give me 100 grand and the referenced index is the S&P 500. It goes up 20%. I'll owe you 120 grand. Hey, both scenarios, ETF, ETN, you get 20%. They say, but Dean, yeah, really? I don't think those are similar. What if you don't pay me? I said, well, that's rude. You're saying, well, Dean, I mean, you're promising to pay me. That sounds like a debt instrument. That's the test question. This is a debt instrument, right? And you have the risk that I may not pay you, right? You're a creditor to me, and then I might default on that, right? So you need to know that an ETN is not an equity investment like an ETF, but rather a debt instrument with the risks associated with being a debt instrument. The risk the issuer doesn't pay you. All right, let's try a test question here. Which of the following products is adversely impacted by credit rating? So again, credit rating means we're looking for a debt instrument. Again, this is another one I pulled from the SIE practice exam. This is a way of testing you. We already right on that ETN and D as in dog is the answer, right? Right. So, good evening. We've been at it. What time did we start? 5:30, and it's coming up on 7. So, 90 minutes. Do you have any more questions for me about mutual funds, the ETFs, ETNs, and REITs from this evening's discussion?
That was great. Thanks, Dean.
You're welcome. You're welcome. I'm trying, Philip, to put a little more of these evening classes up. If you have something you want me to put up, let me know. The next one I think is next week. I'm doing economics. I tried to schedule it so I can get some more folks there. And remember, whether it's the office hours or these classes, they sometimes do change because, thank you so much. I think what you guys gave me $40. So 1, 2, 3, 4, 5. That's what, $200.
This is
Will
great.
we access this?
If we got somebody who wants to pay me $1,000, I'm gonna say I'll move that class. I'll be right with you. So, you're welcome. You're welcome.
Hey,
you know where to reach out.
I
I'll see
have
you. I'm going to put up another office hour. I'll probably do that today or tomorrow. Feel free. I know you participate, Christina, Mickeline, a lot of those. Feel free to nudge me if you don't see it there. Say, hey, WTF, I'll put up the office hour, right?
Where can we access this?
Ethan, is this your first time with us? Ethan, Michael, I think you guys, is this your first time you joined us?
Yes, I was honestly, I didn't know you did these. So, I mean, I go through your YouTube channel, but I didn't know you did these. So,
I'm not very good at promoting these kind of things. I got to figure out how to, but maybe we don't. Maybe we just want the 5 of us. It might be better.
Is there a way to access this to rewatch?
Yeah. Oh, yeah. It goes, well, that's the deal, too. The reason you get a reduced rate is this will be on the channel now as a class replay. So people who didn't want to pay the money. But what you do get, the reason I asked Michael and Ethan, is what you do get as well as, remember, is access to that office hour. And that office hour that's $225 value. The last time it was just Christina, Mickeline, and I, and we spent an hour doing whatever, right? I forget what we did. Oh, Christina, she was demonstrating her prowess in options. She had, brought some option questions the office hour. What you had the short stock with the long call.
Yeah, lots of hedging.
Pretty cool. And then Mickeline had some questions. I think you had some. Were they from the Kaplan Cubic? I think you had a couple as well, right? So
yeah, we went over some of those.
Yeah, so it's just basically you do the chat and we go through it. Can you go over EMH? I can certainly do that in the office. I'll do it real quick here for you. Very test on 65, 66. Efficient market hypothesis. We have 3 forms: weak, semi-strong, and strong. And what we're going to ask you is on the edges. We're not going to ask about the middle, but with weak form, it means it's possible to beat the market. You're willing to accept that some people can beat the market, like Warren Buffett, for example. Strong form means nobody beats the market. Weak form says technical analysis does not work, because technical analysis is using past price performance to predict the future trend. Now, remember, hypothesis isn't true. It's just a hypothesis. I get into my brother all the time with this. I say, Chris, you have a hypothesis. I have a hypothesis. For all we know, we could both be wrong. But hey, I like mine better because it has less moving parts. My hypothesis explains that a little simpler than yours does. He's got a hypothesis that has, 50 people in a conspiracy that makes it work. I'm like, that's crazy. Anyways, so not true, just a way of explaining things. So that means that Warren Buffett fundamental analysis does work, right? Semi-strong. Semi-strong means material, non-public information can beat the market. Material, non-public information can beat the market. Strong means nothing works. It's why waste the time and energy, right? At the end of the day, then what follows is the recommendation. The recommendation, if you are a strong believer in the efficient market hypothesis, I'm not, I'm a typical broker kind of guy. I believe that there are active management strategies that can beat the market, but there's a lot of evidence that that's not true, right? So, but there's evidence that supports that. But it's just a test question, right? That's going to be definitely on your 65, definitely on your 66. right? And you might even get it more than once. You might get the weak form and you might also get the strong form. So that could actually be 2 questions on 65, 66. Anything else for this evening?
I had one. I typed
Yeah.
it in. I won't make you read it.
Oh, let me see.
I,
I was in your biggest option class, Ethan, and you
Yeah.
mentioned upload to sign up. Yeah, when you testing, I haven't done that yet because I just did one like 2 months ago, and I went to upload it, and I thought,
I mean, I can watch the YouTube. Honestly, I saw it. I just
when's your test again?
August 5th.
August 6th.
6th.
Yeah, I got to, I'm just struggling with that a little bit because I'm not sure if it's just going to be you and I doing it. I mean, I don't necessarily mind you and I just doing it, but that would have been more like a tutoring, which is $225. I also have a lot of tutoring replays. I'll tell you what, Ethan, I'm going to August 6th. Where are you at right now in your study effort?
Where am I?
Yeah, I mean, are you ready to do straddles and spreads? Have you done a practice test yet?
Honestly, yeah, I'm it's honestly
Christina,
the
you're
long
taking a 7? Are you taking Christina's taking a 7?
the options.
Yeah, I am
Who
taking
else
the
is
test.
taking a 7? Is
I am. I actually want to ask you something about that after, if you didn't mind.
what's that?
I said I'm testing for the 7 as well, and if I could ask you about that
Yeah,
after.
okay. Sure. I don't know, Christina, what do you think? If I put up an advanced option strategies class, are you going to join Ethan and I?
There, of course. Yeah.
Okay, so there's 2. Okay, and then what about you, Michael? You going to join us?
Yeah, the only thing is I don't do the T charts though.
Oh, that's okay. Yeah, but you don't have to do it. You can do pluses and minuses. You don't have to.
Okay.
If it's going to confuse you, don't do it. But
Okay.
if you're using like Ken's method or whatever, that's fine. But
Okay.
okay, so we'll put it in, and then I'll leave it to you guys to help me see if we can round up a couple more folks. So I'll do that, Ethan. Michael, you had a question about the 7?
Yeah, just in general. So I mean, I test August 14th,
Yep.
and I'm using Kaplan as my vendor. I also use
Yep.
them for the SIE as well. I have the
Yep.
classes
Yep.
next week and everything.
Yep.
I know Kaplan tends to go more in depth on a lot of the math and just in general.
They do.
I've heard. So I started taking 135 question test. I do it like one every day for the past.
Well, don't do more than one a day because you got to remediate.
Right. So I mean, is there like an average score you would look for?
Yeah, so I would just tell you, sunlight's best disinfectant. I am not like a corporate trainer. What I mean by that is there are corporate trainers and companies that think you should get a 90 and they won't even let you test until you're in the 90s.
Right.
I think if you're consistently in the mid 70s and you
Yeah.
haven't memorized questions, I mean, you know what you're being asked, you know what you answered. I think I have every expectation you're going to pass.
Okay.
So the mid 70s is what I'm looking for. I had somebody the other day and they had a one below 70. That's a little worrisome. I always used it's statistics, it's not people. But I had a corporate trainer and I did a class. We did Monday through Friday. Friday, they take a practice test, Kaplan practice. They're testing Monday. We had 20 people in the class. 12 of those folks got over a 70 on the Kaplan practice test. I think they're going to be fine on Monday. And I told her as much. I said, we have 6 of the 8 who got between 60 and 70, and they're still at risk. I think we're going to lose half of those people. And then she said, well, which half will save them? I go, well, if we knew which half, we would save them, but it's just statistics that 3 of the 6 are not going to make it. There's no reason for that. I mean, if they didn't get wobbly, if they finished strong and over the weekend work, that they should pass. By the way, they all did. All 6 of them, they didn't get wobbly. They didn't start going backwards. I always in social media say, stay the course.
Right.
Now, it's not a time to get wobbly, right? Anyways, we had 2 people that got under 60. And now I've had very rarely somebody get under 60 and pass, but it's just so difficult because you don't have enough base knowledge to know what you're being asked and to know what answers are being offered to you.
Right.
Now, I was proud of those 2 folks, by the way. They both got high 60s, which I thought was pretty good because that means they're still working. They're not checked out yet. They're pedal to the metal, and then they circle back and they pass. So we ended up going 18 for 20, and then initially after that, 20 for 20 if you count the retakes. I'm going to count the retakes, and I've had classes where we went 20 for 20 first time out. So mid 70s would be my answer.
Okay.
Michelin, again, I'll give you disclosure. Looks like he's doing that. Oh yeah, took that one already. I err on saying too much than not enough. I'm not a corporate trainer, but if I was, and you miss your mark, I could tell you the first thing I'm going to do. I'm going to go backstage and I have a Kaplan admin key Big Brother key, where I can check in and see what you've been doing. And the first thing I'm going to look at is your QBank usage rate. And, just direct correlation to people that didn't do that. Now, unfortunately, if you're at a firm where you're at risk of not getting that second shot, that could be one of those determining factors, that person who's making that decision. So I think when somebody misses the market, there's a couple of things I always ask them. Did you change answers? What was your QBank usage rate? Now, this isn't me. When I take a test, want to try and exhaust the practice questions I have. That's just me. That's not everybody. So I don't have a number on that, but you've got to do enough questions to get familiar with confirmation of test issues. And you do that by, okay, this is the 5th time they've asked me to do parity. I guess I'm going to have to do that. Right. Or you see one question once, you go, oh, okay, well, gee, I don't think I'm going to have to do that perhaps. So you need to get confirmation. And the way you do that is practice, drilling, and rehearsing. The other reason that's so important is because you can't, like we were doing today, you can't be fumbling around like, oh, okay, let's see, this is the NAV and the pop. What am I going to do here? You got to go, oh, this is the pop, this is the NAV. That's how I do this, right? So practice, drilling, and rehearsing. So I don't have a number for you, but I'm uncomfortable. By the way, that's different. I think there's people who say, you just need to do as many questions as you need to do. I'm like, okay, well, what does that mean? My friend Brian, my brother from another mother, he thinks that as long as you're scoring 70%, you can ditch the questions and move on to new stuff. Now, that's a little different than doing practice tests, I would say. But people make fun of me. I want you to use that. Now, I don't hire and fire people anymore. But I'm telling you, if you were a baby broker and you work for me and you missed the mark, I would be looking at that. And the second thing I'd be looking at is how you respond when you come back. We want everybody to pass, but if you start blaming your test prep vendor, the surprising thing, who blames the test prep vendors more for their failures than any other exam? I get so mad. I go on a rant with these people. The general securities principle people, the Series 24s, whether they use Pass Perfect or STC or Kaplan, they're always I think because they're not used to failures. They don't want to look inward. Sometimes I have to say, stop blaming your test prep vendor. By the way, they have resources to get additional resources if they need be. I said, buy the extra QBank, buy the whatever. So I believe in doing practice questions. I still don't have a number for you.
But I have a question on that. Like, would you say focus your questions on the more testable stuff, or would you just say go in and do a full
pay attention to the weighting? Absolutely.
It's going to pull from everywhere.
Yeah, Series 7. It's harder
when
on
you
that.
say practice, you mean
not much of a
sims.
narrative thread. But on 7, for example, on the 91 questions on investments that 20 are going to be 20 plus or minus are going to be munis, 20 plus or minus on options, 20 plus or minus on mutual funds. So you'd be, silly not to devote that energy. 2 or 3 on margin, 2 or 3 on partnership. So you shouldn't spend a lot of time there. Nobody listens to me, but I say that's not a target-rich environment. Spend that time elsewhere.
But that's my question is, if you're like exhausting your more target-rich questions, would you then go back to the vendor and ask get some others? I don't know if they have others. I think they do.
Well, I don't know if they do. I mean, it depends on what version you buy. But supplement with a QBank. If you don't have a Kaplan QBank, buy one. STC sells supplemental exams as well. So, get some more stuff.
Dean, when you say practice, you mean the simulation exams, right? At least for someone in my...
What's that? I'm sorry?
When you're about 2 weeks out, you mean the simulation exams.
Yeah. I would say, again, playing corporate trainer, I'd say, Ethan, you're 7-10 days out of how many practice. I don't know, Tanya, if you're still with us, but you should be getting... Brian's has very strong correlation. So a Test Geek exam score does reflect, Tanya, the actual exam. So that's good news or bad news. Hopefully it's good news, but it should reflect what you can experience. I'm sorry, Ethan, the question was?
Oh, I was just asking about, when you say practice, you meant simulation exam, not so much.
That's what I mean. So I say, Ethan, don't do more than one a day. I had a guy do 4 and he was so proud of him. So I said, what a waste of your time.
Also, my other question was
performance tracker and see where you need to remediate. And so, that 4 score isn't, we're not trying to learn by doing practice tests. We're trying to get a mark. So we know whether you need to stick the landing or you're still seat back, nose up, trying to get that plane off the ground, right? So that's what we need to do it. So I like to say, Ethan, you're 7-10 days out. How many practice test scores am I going to see from you? then I would be happy you said 4 or 5. You know,
Mhm.
more than that, I'm going to say, well, make sure you got enough time to do that. It also depends on, let's say you say 5. And I say,
Okay.
okay, so when am I going to see these? You know, Monday, Tuesday. The last one should be if you're testing like on a Friday, maybe Wednesday morning, we do that final mark to kind of know what our expectations are for Friday, right?
And
We know you're
also,
at risk or not at risk, right?
mhm. Would this be a good time to start going into the explications? I know you say don't watch certain videos until very close
Yeah,
to your
I think
test.
when you've got
Is that
through all your other stuff, yeah, do a practice test. And then you can watch, you know, the channel. We just put up another one today on the SIE.
okay?
So there's lots of practice tests that you can watch. Christina was kind enough to let me put her tutoring session on the channel. So, you know, I don't put it up unless I have permission, but we have people who give us permission. So I think on 7, we got, I think Lauren was our first person. She's kind of celebrity. The producer and me wants to kind of move people along a little bit on those, but so Lauren's like taking forever. I go, Lauren, no one's going to want to watch us for 4 hours do a series 7 practice test. But you know, hey, she's one of the few people ever who circles and circles and circles and then actually gets the right answer. Usually people are circling and circling and circling don't end up sticking with the right answer, but she certainly did. So you can hit pause and hit play, and there's a lot of them there. The other thing I would use that, Ethan, if you're like your point, you know, I have on there STC, I have Kaplan, I have the Test Geek, Nico, one of my favorite people. We did, I think, one of them, we did this crazy Mometrics one, which was kind of weird. But we have that. So I try and give you access to different, unfortunately, Past Perfect, they haven't given me permission to do it, you know.
And
I feel
there's no
hurt to do, you know, I feel like telling, hey, everybody else lets me do it. Why won't you? Right. So probably because they know I complain about their materials. They're afraid I'm going to, oh, look at this stupid ass question 13. You know?
true.
Anything
And
else for tonight?
yeah, I got one more. They don't have a FINRA Series 7 practice exam.
No, I wish
right?
they would.
That's why I
Yeah.
was looking that up and I couldn't find
No,
it.
they don't. They don't.
So,
I have a couple ones I wrote. They're 4 years. I'm not going to take them down
yeah.
because I think they're still okay, but they're all based on debrief. And I
They're on
feel
the
bad because
channel.
they're not diagnostic. So somebody will get Brian's are diagnostic, mine are not. And somebody will, I got a 90. Does that mean I'm going to get a 90? I go, no, that does not mean that. That just means, you know, these are things you should be aware of on your exam, right? I have a suitability one that is pretty spot on.
Okay.
You know, some of the questions you could see. So I'm doing a little different thing when I'm writing a practice test. I'm trying to share things rather than predict how you're going to do based on a score on my exam. So, but Brian's are diagnostic, Kaplan's are diagnostic, STC, assuming you haven't memorized them, are diagnostic, meaning you can rely upon those scores. Past Perfect, I think is a little tougher, so you can add a little bit. So, those are all reputable test prep vendors. So again, I get upset when people are blaming their test prep vendor when, you know, the issues are do that. But if you have the resource, you want to get something else, why not? You know? All right. Anything else? I think we've been at it now, what, 2 hours?
On your
Nothing
website,
else?
the recording will be there on your website.
Yeah. As soon as we're done, it's a Zoom and it'll record. I already got the thumbnail made, mutual fund class replay. I'm dating them just because, the material's still the same, but I have some videos now. We're going in our 4th year. I don't know why people, you know, if it wasn't no longer current, I would take it down. But I think when people see the date, they go, oh, well, I would say this. We did same day record date. We did make a couple updates to the material. So it'll go up either tonight or first thing in the morning. But next time, if you join us, I allow you in these and office hours and live stream overtimes. I don't mind if you want to hit your own record button, you're welcome to do so. A little too late to tell you that now. I'll try and remember in the future, hey, if you want your own copy, you know, hit the record button and you'll have your own copy. All right. Anything else? How much you should I think I answered everything in chat.
Thank you, Dean. Appreciate
my
it.
pleasure, Todd.
So
Did you get the
much.
answer to your question? You had one. I didn't see you. What was it?
Thank you.
You're welcome. You're welcome. There it is. Yeah, I told you, Tanya. I don't know if you heard me that your Test Geek score is a reliable score.
Yeah, I
All
just
right, everybody.
reviewed him again today.
Remember, inch by inch, mutual funds are a cinch. Yard by yard, mutual funds are hard. Mom heard me say that. She said I got it backwards. Mom thinks it should be yard by yard, your exam is hard. Inch your exam is essential. And I said, no. The inches come before the yards. So, all right. I'll see you next time. Be looking for this either tonight or tomorrow to be up on the channel.
Thanks, Dean.
Bye, everybody. I kind of like that little group. I'm kind of liking our little group we got going.
I know. I like we were lively.
All right. See you later.